Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for December 19th of 2022. Share disclaimer for important information. Well, as we get started this week, some of the notable economic releases here of note include the CPI index, which you see here, obviously, and then we also had the Federal Reserve rate decision, which was pretty impactful as well. Both had meaningful gyrations on the markets. We see here in our overall number, which is in the gray on this chart, the CPI year over year went from 7.7 to 7.1. A notable improvement, but still well above historical trend lines. We know that. Core kind of stayed pretty consistent at or close to about 6%. Here, and you can see that we've had a little bit of gyration over the last couple of months in the core, but then most of the benefit has come in the all-in number. Well, as we see the kind of the internals of the CPI, what you're looking at here is just a breakdown between goods and services. We see the core number here, which I said is kind of gyrated around 6% as of late, and we're kind of stuck in that channel. Again, we've had an increase. Honestly, it hasn't been much higher than that. So you're stripping out food and energy, which are extremely volatile. We know that energy may have come down. We know food prices are real high. That's not reflected here. This is kind of the dichotomy that's building between goods and services, where you see goods inflation has really dropped off, and that has a lot to do with falling demand, which is something that the Federal Reserve can control. And on the flip side, you see services inflation continues to move higher. Some of that has to do with labor costs that are just going to be sticky here. We do see that labor hiring intentions are going down. We see the employment cost index. It looks like it's cresting here, and not sure, where it's going to go over the next several months, but maybe a general sense that maybe we're at or at least close to a peak in wage growth. But you can still see here in that kind of orange line the notable impact that it's having on services inflation, which is actually still going up. And this is one of the things as we talk about what the Fed is going to do when the market is uncertain and has this anxiety over what the Fed's going to do. This is the one chart that you look at that tells you what a pickle they're in right now. Even though they spend a lot more time following personal consumption expenditures than the consumer price index, this is still a good proxy for this issue that they're facing. Well, here's a forecast for Fed funds. You can see it's at different points in time. We start with that bottom line, which was back in last December, and of course that was just throwing something at the wall to see what would stick. And then as the year went on, we could see how these rate increases were going to be a bit more accelerated to where we are now. And looking at the future increases in 2023, a terminal rate now around 5%. Again, not terribly surprising there. It is about 50 basis points higher than where we thought, just maybe a month or so ago, but clearly a lot higher than 6 to 12 months ago. And you can see here, terminal rate, by the end of next year, about 5%, and then rates moving down a little bit thereafter. Now, this is the core PCE, or personal consumption expenditures index, that I was referring to before. This is, in fact, what the Federal Reserve looks at. And you can see, these annual numbers, and obviously 2021 is in the books, 2022 is not. Estimate here is that we're going to have a slight uptick in core PCE expenditures, and that it's going to go down after that. So, maybe a little bit different from the CPI, but this is what I hope will give confidence to the Federal Reserve to maybe slow its pace. I think this is part of what Fed Chairman Powell was pointing at by saying, listen, we may not be increasing at the same pace that we were, again, having slowed from 75 basis points to 50 basis points, but he was clear that they're still going to move rates higher. And I think, with this chart as a backdrop, it sent the market into a little bit of an anxiety on whether they were still going to raise rates too fast and send the economy into a recession, because you can clearly see that PCE expectations are moving materially lower in 2023. Again, these are estimates, so we don't really know yet. But herein lies kind of the issue that faces both the Fed as well as the markets. Take a quick look here at some regional Fed data. Now, this comes out every month, and so we've been trying to keep pace with, some of the more poignant releases. We've got the Empire State, which is the New York area, the Philly Fed, Kansas City, and also Chicago, as well as the West Coast data. And here's the Philly Fed, and it's a good proxy. Again, certain areas have different manufacturing clusters or different service clusters or technology clusters, but this serves as a really good proxy for the rest of the country on what we're seeing in manufacturing. And I can tell you the data directionally is very consistent if you look at prices paid, prices received, employment index, employment costs. It's very consistent. Orders received. It's all of this stuff is slowing down right now in these regional surveys. So we get into some stock data now. Here's a kind of a chart on the MSCI World Index. So we talk a lot about the S&P 500, and with good reason. It's because that's where people are invested, and relatively few people are invested in the international markets. But it's important to realize that the same level of volatility that we've seen here has been a part of the global investing backdrop. And from our peak in 2021, you can see 2022 and the challenges, but also the tremendous amount of volatility that we've seen. These up and down movements have been fairly poignant, and again, I think it's something that we should probably expect to see for the near term. I want to talk a little bit about technicals here. I'm a fundamental analyst, but I do pay attention to technicals. And so, this is a graph of the S&P 500, and it overlaid are two moving averages. And one is a 50-day, and that's in that kind of that lime green. And then that light green is a 200-day moving average. And as you can imagine, a moving average is what its title implies. So, it's basically a rolling average of the past 50 days price for the S&P 500. And so obviously the 50-day moving average is a bit more volatile than the 200-day, which is more of a smooth line. And so you get these inflection points when the market's particularly weak, and particularly a market that's been in an uptrend for a while, but then suddenly becomes weak over a period of time. Then you get what you call these death crosses. And that's what we're looking at here with that arrow and the circle there. We've got back in June when the market was weak, and particularly weak, you saw that the 50-day moved below the 200-day. And when that happens, it typically implies a period of weak market performance. And you can see that in Schwab's work there, when in that bottom chart, that when the 50-day moving average is below the 200-day moving average, and the average annualized return is roughly flat. But when it's above that, it's closer to 9%. And so we just haven't seen the 50-day above the 200-day since that June inflection point. And so, it's getting closer as we get to the end of the year. And so there is a chance perhaps that we will do that if we have strong market performance, to close out the year, and that 50-day punches through the 200. That would certainly be bullish, in my opinion. It's not there yet, but again, that's something that we're looking at, and this type of technical analysis really does have somewhat decent predictive power in terms of where the market's going to go on a near-term basis. As we talk about the equity market, the one thing that we need to focus on is what's going to happen with earnings. And as we see here in the orange line here, there's a noticeable downtick in forward 12-month earnings expectations. And so this is the one thing that I think casts a pall over, the ability for the market to kind of rise in response to optimism surrounding maybe slower Fed rate increases is the fact that, what they've done to date is actually slowing the economy, and I think it's beginning to manifest in real earnings. And we've seen a pretty tight correlation here with the S&P 500 in blue, with the progression of earnings. And obviously there are times where you see multiple expansion and multiple compression, but the problem is, in the price to earnings ratio, that is price divided by earnings. If you have earnings falling, even though multiples have come in quite a bit, that if earnings go down, then that price to earning multiple, then increases a little bit and then has to go down further. So this is part of what has the market in a bit of anxiety with earnings rolling over. We knew that that was apt to happen in a down cycle, but the question is by how much, and that is a question that has yet to be answered. But if we've discussed before, clearly the earnings erosion is not a U.S. phenomenon. Just to be clear, that this is something that's going on all around the globe right now. Is we're in kind of a trade contraction, a global economic contraction. You can see earnings in all markets, major markets, have turned a little bit south as of late. Well, this is certainly a busy chart. I've highlighted some of the things to point out. This is from Charlie Bolello, who does a great job of kind of putting things into historical context. And you look at the number of large down days, whether it be down 1, 2, or 3%. You see in the lower right, I've highlighted 2022 year to date. And again, we've got about 15 days or so, or maybe not quite that many left to go. And we have had 60 days where the market has been down at least 1%. Now, this is not up or down. This is down 1%. And you got to go back to 2008. Again, a recession year. You got to go back to 2002, a recession year. And then prior to that, you've got to go back to 1974, which is in the wake of OPEC embargo. And then you've got to go back, a long time. And I've highlighted the, Great Depression years, but obviously you had some 1937, 38 were also down pretty big too. But, we've had 37 days where the market has been down more than 1%. And, when you go back to the last, few recessions, that ranks pretty high. I mean, well, better yet, if you go back over the last 10 to 15 years, that's a pretty high number. From a perception standpoint, I mean, we've had it really mild in terms of volatility for a long time. And so obviously 2020, we had a few days related to pandemic. 2021, as much as the markets were up in that year, there were some pronounced down days, but less than half of what we've seen this year. And if you include the down 2 days, we've had 15 days where the market's been down 2%, and then 8 days where market's been down more than 3%. That's a pretty profound number, and this is why there's the emotional response on the part of investors right now, because it's hard to look at these days. It's hard to kind of, the emotions are pretty high when you see a down day like this. And it's hard to manage in these days because, the offset here is that there's quite a few days where the market's been up. But the downtrend has been somewhat intact overall since certainly the beginning of the year, but more noticeably, about March to the June timeframe. But again, just to highlight how much volatility we've seen in the markets. Now here's a chart of sentiment trader, and this is kind of like panic euphoria, and so the lower readings are panic. Upper readings are euphoria. Obviously, we came from a place of euphoria after having come from a panic place in the pandemic. And I want to inject maybe a little bit of optimism into this argument because we have seen a lot of volatility like the last chart showed us. But, when you look at, where we are now in this sentiment tracker, if you will, from Sentiment Trader, you can see here the current reading is like slightly negative, about negative 1.7 here. But if you go 3 months out, the average return on this time series going back to 2004 is a positive 6%, which is an 80% win rate. Now, if you go 6 months out, 12.3, and 1 year later, 23.9, that's not to say that that's what's going to happen. It just says that there's a preponderance that when you hit this kind of panic level, it may be, close to what we would otherwise call like a capitulation of investors. And that the capitulation point usually marks the low point in a cycle. Again, it's a positive indicator. It's not an absolute, but this indicator here would tend to suggest that the market behavior over the next, certainly the next 6 to 12 months is looking more favorably. Now, here's a chart that I've shown a lot in different forms and even recently, because I just want to keep pounding this, into people's heads. And now, if you, this is a, S&P 500 compound annual growth rates dating back to 1995 through February of this year. And if you've been fully invested, you haven't pulled money out of the market, you would be up 8.7%. If you missed the best 5 trading days, you would have given up almost a couple of percentage points. You'd still be up 6.8, but you give up some of the upside if you somehow miss the 5 best days. Now, if you miss the 10 best days, you give up more. And what you see here is if you're out of the market and you wind up missing the best 30 days, again, over this time series that's being evaluated, then you would have given up the lion's share of your return. And so this is all to say that, when we're managing portfolios, it's important to know why, what the reason is behind not getting out of the market. It may seem a little counterintuitive to, continue to hold equities in some form or whatnot, but you just don't want to be out of the market and unrepresented when these good days happen. And sometimes they happen during a bear market, in fact. And so, especially if you couple this with what was in the last chart, that would tend to suggest that we're in more of panic territory, which tends to be a little bit bullish over a longer period of time, that, the last thing you want to do is be unrepresented in S&P 500 exposure at this time. Well, and here's another indicator, S&P 500 forward return after an inflation peak. So this is looking at it from a different perspective. It's looking at it, from the point at which I believe we're at now, and that's that we have seen peak inflation. Inflation is rolling over. We just saw on the first slide CPI moving from 7.7% on an annual basis to 7.1. We hope that that's habit forming. We hope the trend continues down, but if you look at, these instances where we've had major jumps in inflation from 1970, 75, 80, 84, 91, that if you look at the next 3 months in the blue, all very much positive. If you go 6 months out, all very much positive again. And then forward 1 year returns are all exceptionally, in fact, above long-term average returns for the S&P 500. So once you've seen that inflation roll over, again, this is pretty agnostic. It doesn't take into consideration recessions. It just says when you've achieved peak inflation, you tend to have positive equity performance, pretty reasonable equity performance in those periods that come thereafter. Well, and I thought I'd throw this in there for good measure. We just had a midterm election. Obviously, depending on your point of view, it was either really good or not great or whatever. But that's neither here nor there. But generally, the S&P 500 price returns in the 12 months following a midterm election, going back to 1950, have averaged about 15%. So again, if you take these last few charts, you've got the panic factor that's pretty high, which is kind of contrarian. Then you've got peak inflation that once you pass it, you tend to have positive equity performance. And you've got this factor, which, it's not economic, but it is tied somewhat because usually you have kind of a reversal of majority status in at least one of the two houses. Um, and you tend to get positive equity performance out of this. Well, I thought I'd throw this in. This is from Fidelity's chart pack, as you can see in the lower right here. But this is kind of what I want to emphasize to everybody that as much as we try to dampen volatility as money managers, as we try to minimize volatility, it's going to be a part of the investing process. And I think it's good to kind of level set us back to kind of this long-term trend. I mean, we got really used to low volatility for a whole number of years, and then we have this pandemic, and then here lately we've had just an incredible, awkward, and very unusual year of volatility. But this is what we should expect going forward. And so 8% annual return, and that's without reinvested dividends. So if you're reinvesting those, then the return's much closer to 10%. But what typically happens in a market is you get three, relatively mild corrections, 5% per year. You get a major, a meaningful correction of 10% once a year. That's probably a part of one of those 5%. And then you get a larger correction every 3 years. And then you get, in that red, you basically get a bear market once every 6 years or so. And, obviously we've had one, we've been in one, and it's the first one that we've seen in quite a number of years. But just I wanted to use this slide to illustrate the fact that, the markets do bump around a little bit, even though that long-term average is pretty solidly in the positive. Especially as we go forward and look at the next 3 to 5 years, and for planning purposes, even beyond that, you can see here at the bottom, it says the S&P 500 percent of positive calendar year performances since 1926 is almost 74%. So 3 out of every 4 years since 1926, the S&P has been up and has averaged this 8% annualized return, or closer to 10% if you reinvest those dividends. Well, here we are on the leading economic index. We've shown this to you a few times. We haven't dropped to this level on the LEI without being in a recession. So, as much as we talk about equity markets and kind of the forecast for the future, it's oftentimes in this LEI, when it drops to this level, we're already in a recession. So the question is, are we there, or are we on the precipice? I know some prognosticators want to say that, we're going to get one later this coming year. I think the chances are better that we get it a little bit sooner than that. With things slowing down, it's just the labor market still remains pretty strong, and that's something that usually does not happen with a recession. So anyway, just to highlight, okay, here we are with the leading economic indicators at a point that is almost 100% spot on with correlating with the recession in real time. Here's a survey, Wall Street Journal. It looked like 740 registered voters, so not an incredibly large sample size, but I think this pretty much sums up the national consensus on this, that most people feel like the economy is going to get worse over the next year before it gets better. And so this has a way of feeding its way into actual consumption numbers. Can be kind of a self-fulfilling prophecy. If you really do believe the economy is going to get worse, then maybe you don't spend as much. And I don't think the revelation is probably set in, because consumption is still pretty high. But at some point, I think it will. And this is what the Fed's trying to achieve, is a demand decline based on the prevailing factors and information that households have. Well, here's a dot plot of recessions and the length of those recessions. You can see the years on the x-axis horizontally there, going back from 1910. Obviously, the Great Depression was significant in so many different ways, and long lasting too. It lasted over 4 years, 26.7% decline in real GDP. And then you see all of these recessions that came thereafter. And, maybe a focus is on, like, say, after 1950, the post-war era, where we had, these recessions um, that lasted anywhere between one, half year to 1.5 years. Not overly significant in terms of the degradation to GDP. Obviously, the pandemic was an exception, but that had its own very special factors tied to it. Financial crisis, probably as bad as we've seen it, 4% decline in GDP there in 2008, heading into 2009. But generally, these recessions on a post-war basis are not nearly as significant as you might expect. Yeah, we'll talk about home builders for a second and mortgages, and we've got some other data here that I think is pretty interesting. Now, you've got, and obviously the recession bars are in gray, but on top of that, in the blue line, you've got the National Association of Home Builders sentiment index for housing. It is an inverted number, so they just basically flipped it upside down, and they've advanced it 1 year because it tends to be a leading indicator on where your unemployment rate's going to be. And so when you invert it and then plot it against in the kind of the amber line here, the unemployment rate, it actually lines up pretty well, and it's a pretty decent correlation. And so what this shows you is kind of what I alluded to before. The Fed wants to see the labor market, begin to erode a little bit, not be so frothy. And I think, when you look at the NAHB line, advance it a year and then plot the unemployment over it, that it clearly suggests that we're going to get increased unemployment in the months ahead. Something that I saw in a tweet, doing some reading this past week, that really caught my eye. Going back to December 2019, pre-pandemic, and we look at home prices versus inflation, been pretty impressive. Now, we know prices for single-family residential have gone up quite a bit, but when you look at it compared to inflation, and these are just kind of like aggregate numbers, it's pretty amazing. You can see here that the price appreciation for homes has gone down at a time where inflation growth has decelerated, even though it's still moving higher. Obviously, we still have inflation. That's not changed, but but the deceleration in home prices and the gap that we've seen there has been pretty amazing. This has had very profound impact on housing affordability, et cetera, and the ability for new home buyers to enter the market. We've got lumber futures. We're at levels that we haven't seen since June of 2020. Just as the whole world was beginning to kind of reemerge to some degree out of the pandemic shutdown, and so this has been on a pretty wild ride. So I just highlight this to show you that there are commodities that are favorable for home construction. There was a time where input costs were so extraordinarily high that it really seemed to justify higher prices. And then now you've got lumber, because demand is falling off, because home buyers can't afford to buy a house, because mortgage rates are higher, so on and so forth. You've got less mobility going on in housing right now, that these lumber prices have really retraced all their gain. In fact, if you look at these markets, Austin ranks pretty high. In fact, number one on this chart from Redfin. But you can see that we have seen on a metro basis. This is the Austin MSA, Metropolitan Statistical Area, that we've seen an 18% decline in the median sale price from May of this year, rather, to November. And you see how that compares with a lot of California, West Coast markets. Honestly, I think outside of the West Coast and Arizona, Nevada, then you're really talking about Central Texas here. Pretty profound. Well, we'll talk about interest rates. So you've got this from Goldman Sachs here, and I think it's pretty consistent with the estimates out there that we're going to have a 5% terminal rate. This is how they see it kind of playing out on an average basis. You've got December, which we did get a 50 basis point increase. Now they're expecting in February another 25 basis points for each of the next 3 Fed meetings. And I think that's entirely possible. Now, again, that kind of premonition, which was kind of, set in motion by Fed Chairman Powell's comments last week, it's caused some consternation in the markets that, increasing rates, even 75 basis points from here, like in these 25 basis point increments, is that it might be too much and drive us into a recession. Well, I think we're already headed there anyway. And I think, this is, the 5% terminal rate before rates go back down is entirely consistent with everything else that I've read out there in the research so far. Chart plotting Fed net liquidity against the S&P 500 index, and not too surprisingly, it lines up pretty well. So we talk about what's wrong with the S&P 500. I think it's actually somewhat easy to tell that when the Fed started raising interest rates, and certainly by the time they started their quantitative tightening program where they were shrinking their balance sheet, that it was pulling liquidity out for the market, and the market feeds on liquidity to help drive up asset prices. I mean, it's essentially asset inflation. Now that inflation in the market has gone away. It's been, what's taken the place of it is more real goods and services inflation, but you can see asset inflation here has been negatively impacted by the reduction in Treasury's balance sheet. A lot of time talking about consumption and the fact that the Fed wants to slow that down. Well, I think you can see some of that in motion here. This chart from the Wall Street Journal shows you categorically which areas are being impacted by a demand decline. You can see department stores, furniture, building, auto, electronics, all in the negative on the month-over-month basis. And the only areas that are really positive: food service, grocery, health, and personal care stores. Well, as we've been keeping tabs here in the housing market, here's a quick look at mortgage rates. You can see they continue to roll over following their peak of just over 7% now. We're closing in on about 6.2, 6.3%. And still trending down because of 10-year U.S. Treasuries moving a little bit lower as of late. That's all we have this week. I hope you've enjoyed the chart pack. We will not be publishing this chart pack next week for the holiday. And in lieu of that, we'll probably come back at you in a couple of weeks with maybe some thoughts on what to look for in 2023, maybe have some charts related to that. Doing a lot of research on that right now. If we see some volatility in the markets, we will be on top of that and probably be back with you with a market minute comment on that. Not a whole lot of data to come this week. Things are really kind of slowing down for the holiday, and there are a lot of people that are actually going to be shut down in the week between Christmas and New Year's. So in any case, hope you have safe travels if you're traveling, wonderful time with your family and friends, and we will talk to you again soon. Take care. Bye.